Hello, and welcome to our first quarter strategy review for 2020. We met here in this room on December the 20th, and all the talk that day was dealing with impeachment. But things have moved on, and we'll get to that as we go through the review. In the meantime, we did have a guest, as we have been recently. The gentleman's name is Abdur Numari, and I believed I pronounced that correctly. He's a vice president, and he is head of multi-assets at Northern Trust Company. His remarks, again, were very interesting and really gave us some additional perspective. But in addition to that, of course, on my right, we had Len Skeena, Vice President and CEO of the firm. And on my left, Bob Toomey, Vice President and Director of Research. As I said, we'll get into our comments and what we talked about at that meeting. Again, a lot of the discussion had to do with what the effects would be on impeachment. And as you'll hear from the other fellows as they go through their individual remarks, we found that that was probably a non-starter, and the markets kind of reflected that. Since then, we of course are now dealing with the Iranian situation, and if we had thought that was going to happen, it may have well become a trigger that we may have said if we were going to war, maybe we needed to do something. But once again, the markets are very calm. They are really not indicating that we are going to war, and we're hitting new all-time highs. As you'll see, we were fairly positive throughout the meeting, even with the impeachment concerns, and I guess with the benefit of hindsight, since we are now at January the 9th, we did get our video done a little bit late just because of the holiday season. We can now deal with that and look at that as well. And again, it does seem to have little impact on the markets, and that's probably a positive. With that, I would like to turn specifically to Bob for comments on the equity markets.
Well, thank you, Stan. And I think it's a great summary of what has been happening really since we had our meeting on December 20th. If I could encapsulate the equity markets in a word, it would be steady. I think the behavior of the market here opening in the early days of 2020 trading is pretty much as we expected. We did expect the market to be positive on the opening for a number of reasons, and it has played out that way. When I talk about steady, I think there are several ways to reflect that. Number one, I think the economy remains steady. We continue to see, as you are, I'm sure, very aware, steady growth in employment and consumer spending. We think the economy can grow again at a steady, roughly 2% pace in 2020, with the potential perhaps for some upside to that later in the year. Federal Reserve policy also remains steady, and the Fed has indicated that they have no reason at this point to change policy in a material way. Inflation also remains steady, and we think that could be around 2% again this year, with again the potential for maybe a little bit of upside to that later in the year based on wage inflation, but at this point we still do not see any significant risk of dramatically increased inflation. So I think what the stock market is really doing is it's discounting an improving global economy. I think it's more encouraged by the pending phase one trade deal with China that is going to be signed on the 15th of this month. And all of those things are, I think, what are contributing to this rising market in the early days here. One thing that I would want to say is that bullish sentiment does appear to be fairly strong, and as for me on the research side, is a little bit of a concern, is a growing concern for me. And I would not be that surprised to see some sort of modest correction in the first quarter at some point. Again, your portfolios are diversified so that you are protected and from a potential correction. but also be aware that modest corrections are normal. They are part of what the market goes through continuously, and we're not overly concerned right now about a major correction. With that, let me turn it over to Len, who will talk a little bit about the bond markets.
Thank you, Bob. When we met a year ago, the Fed had a policy where they were raising rates. And in the spring, the Fed induced whiplash by switching from a rising rate environment to lowering rates on a dime. They just turned around and didn't even pause. They just started lowering quite a bit. We actually expect the lowering of rates to continue in a modest way at this point. As Bob said, the Fed will remain steady with what they're doing. But we do see that the rates from the market-based side of things, the intermediate term rates and the longer term rates, will likely go up over the next quarter or so. And as we see that continuing to happen, you'll see a steepening of the yield curve, which last spring was a concern when the yield curve inverted in places. With the Fed doing that, we have continued to maintain a shorter duration, and we're shying away from the longer duration in bonds. We're also employing a couple of alternatives that we weren't employing before. We're continuing to represent the bulk of the bond portfolio with treasuries, and we will continue to do that. But we are introducing some mortgage-backed securities in the intermediate term area, and we're introducing preferred stock in the long-term area. Both of these should help increase the yield in the overall bond portfolio and therefore hopefully increase the overall performance there. With that, I'd like to turn it over to Stan to talk about REITs.
Thanks, Len. REITs, actually the guys always give me the ability to talk about REITs, which has actually been a very strong part of our portfolio and continues to be a very strong part of our portfolio. We once again feel comfortable in the REIT area. However, as in recent quarters, we've been concerned about the one component inside of REITs, which are the large shopping centers. With the problems with the brick and mortar retailers, actually this morning there was one on Best Buy. It does bother us that that section and that sector may have problems over time. So we have continued to segue, if you will, into a REIT which specializes in medical properties. And we've had that in the portfolio for a while, and it has done very nicely. But since REITs continue to throw off a large amount of dividends, generally larger than most other segments, we continue to hold our REIT portfolio, and we continue to hold a full and even a slightly overweight in that area. With that, I'd like to turn it back to Len to talk about the international markets.
Thank you, Stan. On the international front, as Stan alluded to in the beginning with his opening comments, we weren't really concerned at that point about the Iranian situation or with the U.S. potentially going to war. Although even now, as we sit here today and record, we are looking at a situation where the markets seem to be very calm and are shrugging off the possibility of this, thinking that it's not a very, very strong likelihood that we will do so. But we did see a couple of things that we were looking into and had some relatively strong discussions on, one of which is the whole concept of the Brexit vote and the idea that Britain is going to be leaving the EU. The other thing that we were talking about that was big news at the time was the Phase 1 agreement with China that looked likely and continues to look very likely to go through and to hopefully be something that will strengthen the overall global economy. Combining both of those with the uncertainty regarding what's going to be happening in the EU and with the potential for an increase in the areas that are most dependent on China, we are deciding to introduce at this time an allocation to our emerging markets ETF, and we are going to be not overweighting ourselves by any means to that. The bulk of your overall allocation will continue to be in the developed economies, but we are looking to see some additional return. We think now is a good time to be getting into the emerging markets, and we have chosen to introduce a small portion of the ETF for the emerging markets into the international portfolio. With that, I'd like to turn it over to Bob to talk about the changes in our holdings.
Great. Thanks a lot, Len. So I think Len did a really good job in outlining the changes within the fixed income area, the addition of preferred stocks and mortgage backs, which I'm encouraged because it's going to provide greater yield for your portfolios. I was also very encouraged about adding, as Len mentioned, the exposure to emerging markets. I think that sector will be one of the prime beneficiaries of improving trade relations with China. We also added in the quarter a segment in the transportation, the U.S. transportation sector, in the iShares Transportation ETF. And I believe that is an important addition because with improvements in the sentiment towards the U.S. and global economy, transportation stocks are cyclically exposed and should benefit from increased and improving sentiment in a stronger U.S. and global economy. We also increased our allocation to small cap stocks, largely because we felt they have underperformed now for several years. We think they offer very good value, and we think it was a good time to be adding to that sector. We did maintain our positions in healthcare technology and software because we believe that those sectors are significantly above average growth potential, and we feel confident that they will add to the overall growth of your assets in your portfolios for the foreseeable future. So with that, I will turn it back to Stan for closing remarks.
Thanks, Bob, and thanks, Len, as well. As you can see, we generally decided that the political upheavals, the political problems, had not been affecting the markets that we deal with day to day, and we felt like they probably would not affect the markets as we're dealing with them day to day. So you can see from the remarks we remain generally positive as we look forward, and your portfolios are basically pretty fully invested. The changes that we made were made primarily to deal with some of the problems that you might be anticipating in lower interest rates. Lower interest rates are good for a lot of people, but on the other hand, they're not so good if you're trying to get income from portfolios, which, as you could hear, we are still trying very much to achieve as much as we can. Now, in terms of the trigger that we would say, what would change our minds? That's what triggers are for. We set one every quarter. You may recall that we actually pulled one when we dealt with the tariff problem. But looking out into the next quarter, we said, what would change our view? And on the screen now, you will see a chart of the 10-year bond. The 10-year bond, as Len indicated, early last year, actually, the Fed was raising rates, and the 10-year bond got up to 2.75 during that period. However, now the 10-year bond is well under 2%. It's actually under 1.8 as of this morning. We said that if there is a change in Fed policy, if we do go back to that tighter Fed policy that we had a year ago at the same time, that would cause us to be concerned, and that's where we would reduce our exposure pretty much across the board. So again, that trigger is what we have set for the next quarter. In the meantime, we're looking at what looks like a reasonable market in the next quarter, and that is how we're positioned. Keep in mind that we always have our videos posted. We've been doing these now since, believe it or not, 2013. And please take advantage of that if you like. And we will look forward to tuning in next quarter.